Many of you know who Warren Buffett is. If you don't, do a quick Google search. You will find out he's an impressive entrepreneur, investor, thinker around business and wealth. And Samson keyed up a stat for me that was super impressive of just how.
Yeah, I heard it last night. So I was watching and listening to a podcast. If you guys are subscribers to the newsletter, I sent it out last night. It's a great podcast. But the fact was 99% of Warren Buffett's wealth was created after the age of 60. And that just completely blew my mind. And so we're going to watch a little clip on here because it's kind of long. So we'll skip around a little bit, but just to talk about what his strategy is. And then I broke it down just to give everybody the highlights in and around that. But the simple takeaway is this: time in the game matters more than anything.
Again. And those are the things that you should pay the most attention to.
I think that's fascinating, right? Because when we look at Buffett, what we want is the outcome. And what we don't think about is all the things that go into creating that outcome. So what stays the same between all these different decades where he's done this, right? Yeah. So he's done it from buying net Ben Graham stocks all the way to buying great businesses, all the way to the patience to do nothing, and then once every 10 years deploy a whole bunch of cash.
Yeah.
What is consistent across that period in your mind?
Two of the big ones, we could come up with dozens of things that are consistent with someone like Buffett, but the two big ones are endurance and maybe tied to that, capping a downside risk that allows him to stick around for longer than anyone else. There's also a psychological trait of wanting to keep going longer than anyone else. I use a stat in my book that 99% of Buffett's net worth was accumulated after his 60th birthday. Like the vast majority of people, including me and maybe you, if we became a billionaire at age 60, would be done. You'd move to Florida and buy a private island and like live happily ever after. For him to be that successful and to keep going full blast for what's now another 33 years and still going stronger than ever is a very unique characteristic that plays a massive role in his success. If Buffett had retired at age 60 or 50, like a normal person would have in that situation, you would have never heard of him. The whole reason he's so successful is just the endurance. And there's a psychological and a financial component to that. Never getting wiped out financially, and the psychology that will allow him to keep going full blast for nearly a century on end now.
But
cool. You can pause it right there. So one of the things, if you actually listen to Warren Buffett talk, he talks about the power of compounding, right? This is being in the game consistently year after year, day after day, week after week, and doing it in a low risk environment. And so I cut my teeth in the world of investing as a futures and commodities broker, which is some of the highest leveraged, most volatile trading that you could ever do. And my mentor always talked about it's more important to know what your loss is going to be and cap that before you ever get into the trade.
So that's the downside risk piece.
That's the downside risk piece. So we always were taught you never trade without a stop loss. Stop loss means if the market goes down or up, depending, because in futures markets you can buy or sell. You can get into the market either way. You always know that if it reaches this point, I'm out. Like that's my threshold. And the law of probability said that if you're going to take a number of losers. In fact, you're going to have a string of losers, but your one winner will be so substantially bigger than your losses if you protect your downside risk that it won't even matter. So it was all about taking small calculated risks, small calculated losses, and doing that consistently over time because your one winner was going to far exceed any loss that you ever took. If you hear Warren Buffett he'll talk about don't try to time the market. He talks, everyday investors should be investing in the S&P 500. Because if you look like over the last 4 years, 7 of the 500 stocks in the S&P 500 held the entire stock market up, right? They propped the entire stock market. So it's very challenging or impossible to pick individual stocks. So if you're an entrepreneur and you're running your company, obviously that's like the most important asset that you have. But what we got to get better at is we need to parlay that into long-term kind of things, right? Buying Bitcoin, investing in the stock market. Those are things that will protect us in the event that something crazy happens, like a COVID or a life crisis or something along those lines that is completely outside of our control. And if we go down and we can't run our business, or it's not to a point where it's self-managing, then we have a real problem, right? So you got to have a long-term outlook, long-term perspective. You got to be in the game consistently. Value investing. So he always talks about, obviously, he finds great companies or inefficiencies in the market, and he goes all in on those things. When the market drops cataclysmic, you should be investing into the market. That would be value investing. It's never been cheaper than it was today, basically. And then the other thing, a part of his philosophy is just business ownership, right? So he doesn't really invest in real estate per se, but he'll invest in companies that invest in real estate or invest in companies that service the real estate market. And so that's important to note as well. And then obviously just patience. And then the other thing he goes on to talk about in that podcast that we don't really have time for is just the number one quality that makes a great investor is not having FOMO. Being able to look at your neighbor, see them being successful, and they're driving nicer cars than you, moving up in the world, making more money, and it doesn't impact you at all. It doesn't change your strategy. It doesn't make you want to go buy a nicer car or spend money that you don't have, because it's not, wealth is made in the money that you don't spend, right? And the money that you not necessarily save, but you invest. It's not made, buying a car. That's the illusion of wealth. Yes. Being wealthy, and they talk about this too. There's a difference between being rich and being wealthy. Being rich is having enough money to, live a high class life. Being wealthy is how long can you go without having to work? That's the true definition of wealth.
Let's go.
I just think for entrepreneurs, we need to talk about it. I talk to a lot of them who've never really thought about what the future looks like. All their eggs are in that basket, and they'll cut themselves off from learning about these other strategies. And so just impactful lesson for myself too. It's always a great reminder.
Well, it's funny. I was actually falling asleep last night, reading some stuff and listening to some stuff on Charlie Munger and Warren Buffett. Didn't even know we were going to talk about it on the pod, but just I had heard this term, economic moat, and I had never really looked into the definition of it. That he's popular. He's really the one who popularized it, made it popular, and it was very interesting of just thinking about that. Obviously in business, the finding competitive advantages that continue to allow the business that you're going to invest in outperform and have a leg up is the moat. But I was thinking about it just personally, and that's the moat, right? It's like capping your downside risk, playing the game with a mindset of longevity. Right. That is your moat. It's because everything around you is constantly doing this. So
yeah, and that goes for entrepreneurs too. That's why time in the game matters. It's why you hear us talking about buying a business, maybe over starting one. You're buying a business that's been around for 20 or 30 years. There's a moat around that in the sense that they already have brand reach, they already have relationships, teams, processes. The market knows who they are. Right. So that is a moat. Yeah, that makes that a potentially better investment.
Correct.
If you're in a startup or you're starting, you need to change your time horizon. Like you need to be thinking about 10 years, not a year. 2 years, 3 years. That's not even enough time, you know? So can you stay in the game for 10 years? That's the difference. Yeah. Did you know that Warren Buffett and Charlie Munger had a third partner?
I didn't.
Yeah, they had a third partner, and nobody knows who Rick Guerin is.
Shout out to Rick. That's the way you want to do it.
Well, no, you don't. So here's the 3 mistakes that led to his ultimate demise.
Oh, sorry, Rick. My bad. I thought he was one of the good ones.
Mistake number 1 was wanting to get rich quick. So they weren't making money quick enough for him. So he decided that this was a bad strategy for him. So he wanted out. Mistake number 2 was spending beyond his means. He liked to live in the lap of luxury. And then mistake number 3 was failing to diversify investments. And so he was a partner that was there in the beginning and then decided to get bought out. And that was I can't remember what the stock price on Berkshire Hathaway was at the time, but it was nominal in comparison to what it's worth today. Wow. I mean, Berkshire Hathaway stock today is it's something crazy, like $400,000 a share. Hold on, let me look this up. Yeah. As of July 16th, 2024, Berkshire Hathaway Class A stock was trading at $657,735 a share.
That's insane.
That is insane, right? Because it's a holdco that owns a bunch of other companies, right?
That's crazy.
Time in the game matters, baby. Stacking businesses, stacking equity.
Jeez.
Yeah, wow.
I'm just thinking about all those old heads that were in early.
Well, I mean, historically speaking, when's the best time to plant a tree, right? 20 years ago. The next best time today. So there's no better time to do that right now. The market might be different. Things might be more expensive.
Yeah, go invest in Andrew Wilkinson's company.
Yeah.
Yeah.
Exactly.
Speaking of, okay, I made 2 observations in that video outside of the content. I was looking at the background a little bit. I'm reading his book right now, Never Enough. And I'm pretty sure either that guy who's interviewing him for the Knowledge Podcast is involved with Tiny in some way, or he bought those 2 busts from Andrew Wilkinson. So, because he started a business selling Charlie Munger and Warren Buffett busts.
Oh, smart.
But I'm pretty sure those are 2 of his busts. And then he had a wine Bible back there. Just 2 random factoids I saw.
Which isn't a Tiny product?
No, a wine Bible is that's just a book that basically walks you through understanding wine across the world, history, the varieties, all various different
things that like sommeliers learn.
Yeah.
Yeah, that's cool.
So
speaking of sommeliers, side note, have you ever seen those sommelier contests?
No.
Where they drink the wine and they
have to tell you what it is?
They have to tell you where it comes from. They have to tell you the origin of it, what the grape is. It's pretty amazing. Have you ever seen that, Cole? Oh my gosh. We're going to pull it up on one of these episodes. Yeah. It's wild.
Bet.